Welcome back, everyone, to Market Wrap. I'm Mo Ansari, and you're tuned in as you've been doing so for over 2 decades now. And as always, wherever you are, from Miami to Seattle, from California to Rhode Island, and even in Honolulu, you can always pick up the phone, give me a call, and I will be more than happy to share with you my nearly 36 years of trading experience. But for the next few minutes, hold your calls. It is that time of the day where we go to our guest line. And today on our guest line is Mr. Jay Taylor. He's editor of Jay Taylor's Gold, Energy, and Tech Stocks newsletter. Throughout his career, Mr. Taylor worked as a commercial, then as an investment banker, including many years at Barclays Bank International. Most recently, he worked in the mining and metals group of the ING Barings, New York. Prior to that, he was involved in the first gold loan made in modern times in the U.S. to Amex Minerals, a 250,000-ounce loan facility led by Citicorp. Mr. Taylor now devotes himself full-time to researching mining and technology stocks, writing his newsletter, which is now in the 30th year, and assisting companies in raising venture capital. Today, his portfolio that is recommended is up over 280%. That's as of March of this year. Mr. Taylor, welcome to Market Wrap.
Well, it's a pleasure to be with you.
Jay, let's start with the gold. Lately, we've seen the gold rally market is rallying. Do you think that we are going to get QE3 and we are going to get quantitative easing in Europe by the ECB, or are there other reasons that have pushed gold back up to the 1675 area?
Well, I'm less of a trader perhaps than you are. I'm more of a long-term investor, and I believe that gold is in the bull market of a lifetime right now, that it started in the year 2002, but honestly, the real gold market, bull market, didn't really start until the Lehman Brothers decline, and that was a decidedly deflationary event. We saw the real price of gold rise very dramatically. Mm-hmm. That is, what an ounce of gold would buy rose very dramatically after Lehman Brothers, and I measure that against the Rogers Raw Materials Fund. Recently, it's hard to say from day to day. I think that why the gold price goes up, but I think that there's no question whether we formally get QE3 or not. What we've seen even before QE1, even before Lehman Brothers, was an increasing amount of QE, that is, the Federal Reserve buying Treasury debt. And the reason for that was because there was a decreasing appetite for U.S. Treasuries from our creditor countries, from China and from Japan and other countries. And so to keep interest rates low, to keep them artificially low, to keep people consuming, they've suppressed the interest rates and pushed prices down. And that, of course, is bullish for gold, because if the carrying cost for gold is less, and if you don't have any opportunity cost to take your money and invest it into high-yielding, safe instruments, then people start to go to gold. And, of course, the last major bull market we had in gold was squelched by high interest rates by Paul Volcker. Mm-hmm. So if the people who hate gold and love paper money want to keep the paper money in check, at some point they're going to have to, I think, they're going to have to allow the markets to decide what interest rates should be. And that could be very, very bearish for gold. But as long as the policies remain as they are now, that is to continue to print money, then I think it's very, very bullish for gold. And I think that we're going to see prices much higher than they are now eventually, in nominal terms and in real terms.
So you think gold is going higher in nominal and real terms over a period of time. Do you think that is because they're printing so much money, printing so many dollars, or is it going to be inflation that is going to push gold up? Is it the lack of confidence in paper currencies, lack of confidence in governments? What do you think is going to be the main catalyst?
Well, I think all of those reasons that you just mentioned. I think that, whether or not we end up with a deflationary solution to this malaise, or a hyperinflationary solution, quote-unquote solution. I don't think they're solutions, but the system is going to break down, in my view. Mm-hmm. And the question is, how does it come about? Well, I lean towards the deflationary view, honestly, and in that case, I think we could actually see nominal prices of gold maybe not go up that much or even decline, but the real prices could rise. So, I don't know which way it's going to go, but the policies are destructive of the fiat money system right now, and it's a combination of things. I think there is a loss of confidence. Look, It's a loss of confidence, and this whole notion that you can stir animal spirits. Keynes talked about animal spirits. I call it a con job, really. It's called confidence, keeping people confident in the system. Well, how can you be confident in the system if you're broke? And people are around the country increasingly broke. And as long as they could issue more credit cards and people could go out and spend more money and continue to consume and live beyond their means, they were happy, and the economy grew. The problem is we've reached that level now where that cannot be taken any further. The debt, the amount of debt that is issued cannot grow anymore, and that's why they're having such a heck of a time getting this economy to grow. Why monetary stimulus no longer works, because the masses of people, and I'm talking middle-class people, are broke, with student loans, with mortgages, with what have you, credit card debt, and so forth. So we see a little bit of a cleansing of the system after Lehman Brothers, and the savings rate went up momentarily, but then we got to keep those animal spirits up, so let's get people to spend again, and they go up to the limit. So, I think that the whole problem that I see in the Western world was created when Nixon took us off the gold standard in '71, because that meant that countries could print unlimited amounts of money,
right,
up to a point, and they did, and they created money, and people spent until the debt became so high that it cannot be.
Jay, you just talked about going off the gold standard, that Nixon took us off there. Now there's a lot of talk by the Republicans that we should go back on the gold standard. Do you think that could happen?
Well,
and is that a good idea?
I think Ron Paul would be the voice of the Republican Party. I don't take it seriously. They're supposed to have a gold commission, as they had under Ronald Reagan. It was never really taken seriously. No, I don't think that's going to amount to anything. I don't think the Republicans are going to do that, because the bankers are in their hip pocket, or let's say the politicians are in the hip pocket of the bankers,
right,
just as the Democratic politicians are. No, not until the system breaks down, I think, or until China or other countries require it. In order to continue buying our treasuries, or being, they could dump them, I suppose.
Jay, looking at the gold mining companies, some of them are doing better right now than the gold market. Do you think there's a better opportunity investment in gold mining companies or the bullion?
Well, I think you need to own both for a whole series of reasons. But I think at the moment, I think the gold shares have some catching up to do with the underlying bullion. But that said, we've seen a bullion market that's been sort of in a correction phase over the last year or so. I think we're going to see a rise in the bullion prices as well. And I look at something that actually I've kept these statistics since I worked for ING Barings. The average gold price every month, and I looked at that as compared to the 20-month moving average, and every time since 2002, the bull market started in gold, whenever that average, monthly average, come down and touched that 20-month moving average, we've seen a major rise in the gold price.
So that's a good buy trigger right there, that whenever
yes,
we
it has been. It's something like an average of 37 or 38%, with a lot of variation there. But I think that I'm very bullish on the shares. But the main thing that I like to emphasize and watch very carefully is the real price of gold, because as a miner, I want to get I'm only in business to make a profit.
Right.
I want to get the gold out of the ground and book a profit. And I can do that as long as the real price of gold is rising. And we've seen a rise in the profits of these major gold mining companies, very substantial rise in profits. After Lehman Brothers, the price, an ounce of gold would have purchased only 17% of the Rogers Raw Materials Fund before Lehman Brothers in the summer of 2008. By March of 2009, it went to 43%. So you had almost a tripling in purchasing power of that basket of commodities.
So it's what
gold.
You can get with 1 ounce of gold, what you can get with it. It's not how much it costs, but if you can get a lot more stuff with it, that means the price of gold is going up. Let's move on to energy a little bit over here, Jay. Oil prices are rocketing again. Do you think this is just a short term, or do you see an uptrend continuing for some time in the energy markets?
One of the things I think, one of the side effects of QEs is speculation in commodities. And where is the demand for energy coming from? If China is slowing down dramatically, the United States is the strongest economy in the world, and it's not doing very well, and Europe is in a recession. Where is the demand for energy coming from? I ask you. I don't know. I mean, China's still growing, I suppose, the number of people driving cars and so forth. There's some of that. But I honestly believe a lot of it is speculative. I think a lot of money is going into the commodities by people that have access to that QE money that goes into the banking system, the hedge funds, the people that have access to play with it, because Lord knows it isn't getting lent out. Mm-hmm. The banks are flush with cash, but they can't make loans for the reason I was just suggesting a moment ago. That is, people are broke, and companies that don't need the money, companies that are credit worthy don't need the money. And of course, they've kept interest rates at artificially low levels, so corporations are going to the debt markets now and borrowing at ridiculously low, under the market rates as well, I think. So, no, I think energy prices are high, and oil prices are knocking on $100. I don't know. I mean, I'm very, very concerned that we could go into another Lehman Brothers-like equity market decline. Mm-hmm. And so I'm a little bit worried about, and I'm not nearly as bullish on oil and the commodities sector in general as I am the monetary metals, because of the monetary fear, the fear of the fiat system. And it's a fear that is completely legitimate in my view.
Let's quickly move on, Jay, before we run out of time. We are talking to Mr. Jay Taylor, editor of Jay Taylor's Gold, Energy, and Tech Stock newsletter. We've got to cover tech. What is your take on the tech sector right now?
Well, I don't follow, my expertise, and I don't really follow that many tech stocks right now. And when we talk tech, I'm talking more in terms of technologies that reduce the cost of producing life's essentials, like water and energy and so forth. And so there are a couple of things that I'm looking at. They're more speculative at this stage. As far as IT and that sort of thing goes, I follow it some, and I think I don't know. I think, look, this Facebook debacle is sort of worrisome, and I wonder if we're not near another peak. I hope not, for the sake of my son, who works in the industry, and he's a programmer in Silicon Valley. So
I think we look at Apple, it's getting bigger and bigger and bigger, and they had a big victory on Friday where they beat Samsung, and looks like everybody wants to get their new iPhone and get all of the stuff. Mr. Taylor, I want to thank you for your time. I do appreciate you taking the time out of your busy schedule and being with us today on Market Wrap.
Well, my pleasure. Thanks for having me.
That's Jay Taylor, editor of Jay Taylor's Gold, Energy, and Tech Stock newsletter. Stay tuned. You are listening to the daily edition of Market Wrap. I'm Mo Ansari. I'm going to take a short break, and I will be right back.
You look like gold to me, and I'm not too